Thank you very much indeed for being here. Today we have the pleasure to introduce you Andrea. Andrea is the current chairperson of the European Banking Authority. He got his first mandate in 2011 and he has been reappointed until 2021. Andrea has a BA in economics from Bocconi University and an MPhil in economics from Cambridge University. He worked for 10 years at the Bank of Italy between the late 80s and late 90s in the research and in the supervisory department. Then he moved to the ECB, where he also held the position of head of financial supervision division between 2004 and 2005. And 2008 he was Secretary General of the Committee of European Banking Supervision, and then he moved back to the Bank of Italy in 2008, where he was the head of supervisory regulation and policy department at the Bank of Italy. And then in 2011 he was the third chairperson of the European Banking Authority. Just one reminder, I mean the talk is recorded, but then the Q&A will be held under Chatham House rule, which means that what it is said cannot be attributed. So thank you very much, and it's a pleasure. Please welcome Andrea again.
Well, thank you very much, Marco, for the introduction, and thank you to Charles also for inviting me here. It's a great pleasure, and I hope that I mean, in general, I very much like this type of environment where you get more interaction and discussions than usual speeches. So I'm very pleased to be here. Charles suggested that I could focus on Brexit issues. I thought to widen a bit the scope to put Brexit within the framework of the broader tendency to fragmentation in banking and financial markets. And of course, coming from a banking agency, and the European Banking Agency, my focus will be mainly on banks and on the European Union, although I will also have some broader perspectives. So I will start with a sort of stock taking of where we are in terms of financial integration, and try to go back to the drivers of the disintegration in banking and financial markets, or ring-fencing, distrust between authorities and financial protectionism. I will then try to focus on Brexit as one specific example, I mean a big example of fragmentation in the core of the single market, of European financial markets. And then I will try to go a little bit through the policy challenges. If we have a policy objective to restore integration, what can be done and what should be our focus. Finally, I will put on the table a few hints, because we are now starting a project on cross-border mergers and acquisitions, and that will remain, in my view, an important litmus test on how far we will be going in terms of restoring integration. Now, the first point I want to bring to your attention is the evidence pointing to the disintegration in European financial markets. I mean, it is clear that there has been a sort of quite material contraction in cross-border banking activity since the crisis, and we have had frequent references to deglobalization. The concept of peak trade was transposed also to peak finance, so the idea that financial integration had reached a peak and was now bound to settle on a much lower level. And it is indeed true that both trade and finance no longer grow faster than GDP, so we have reached indeed a turning point. What is interesting also is that while trade recovered somewhat, finance indeed didn't. and actually the contraction has been deepening. Now, the interesting point, and there is research here from the BIS staff, Macaulay and others, is that the phenomenon has been driven to a large extent. If you take the global flows, which is the top chart, let's say, then you try to go deeper and look at different jurisdictions, and especially if you look at the data on a consolidated basis, so considering groups and their subsidiaries and branches in other countries, what you notice is that this deglobalization trend is mainly a European phenomenon. So in the left-hand side of the bottom chart, you see the European countries, and you see that in all of them, the banking groups have retrenched to their domestic markets, have reduced their assets in markets different from their home, let's say, where they have the headquarters, with the only partial exception of Spain, but all the other, which is more global. Spanish banks are more, let's say, focused on Latin American markets, and so they're a little bit peculiar also in the European Union. But if you look, for instance, at jurisdictions outside the European Union, so Australia, the US, Japan, Canada, you see that there is a blip at the moment of the crisis, but then, let's say, the trend resumed and they reached again the pre-crisis level. So there is something European going on here, and the cross-border claims have actually reduced substantially. In the European Union, on average, it's more the reduction was from approximately 60 to 40% of GDP as a result of the crisis. Now, still remaining on the evidence, I mean, that's if you want the charts on which I will focus most in this presentation, because in my view is really the core of the issue. If you take in traditional price or quantity indicators of financial integration, which is the top left chart with the yellow line being the price indicators and the blue line being the quantity indicators, what you see is that there was a significant increase in integration from, say, the introduction of the euro going, let's say, from the planning of the introduction of the euro and then until the subprime crisis. And then there was a significant decrease of all the price indicators. What is interesting is that, of course, this trend was reversed in the moment in which the ECB started announcing its extraordinary monetary policy in 2012. And price indicators recovered somewhat after that. Not so for quantity indicators. And especially, these are indicators which do not take into account of the group dimension that I mentioned before. So in terms of quantities, the cross-border flows were declining significantly. What we see was that mergers, which are in the bottom left part of the chart, decreased in number, and especially the domestic component was dominating. All the acquisition of assets in other countries, or the controlling acquisition of assets, was domestic, basically, since the start of the crisis, which means that all the consolidation took place at the national level. Now, here, to me, is the core point. When you enter into a crisis, you always enter into a crisis with excess capacity, basically, in the system. The sector has developed too much, and you need restructuring. The way in which you restructure the system is generally through, let's say, firms exiting the markets, others buying their assets and liabilities, mergers. Now, what happened, if you take, for instance, the US, you had 500 banks basically exiting the markets, and you had the FDIC, so the federal agency in charge of deposit insurance and restructuring of banks experiencing crisis, was generally selling branches, assets and liabilities of these banks to banks also from other states. And this led to a much faster restructuring of the system, a lot of reduction in the excess capacity, an increase in the concentration in the system, and what is more important, to the system playing the role of shock absorbance that financial integration is supposed to play. So you had banks which were more diversified across different regions. So if you had the crisis in Nevada, as you did, let's say having banks buying assets and liabilities in Nevada from other states in the union contributed to, spreading the losses across states and making the system as a whole more resilient. So there was, in a sense, a greater ability to absorb shocks thanks to financial integration. What happened in the European Union is the opposite, that there was very little consolidation, excess capacity stayed in the system, only 50 banks exited the market actually. There were more bailouts that actually exits from the markets. And what is interesting is the chart which is on the top there on the right. I know you will not be able to read anything, but I will try to guide through it. Basically, what that chart says is the yellow bar is the contribution of the credit channel to the absorption of idiosyncratic GDP shocks. So you have a GDP shocks in one place, and you see how the credit channel helps distributing these credit shock and let's say across areas. And what is stunning is that since 2009, the yellow bar is negative territory, which means that the credit channel amplified the shocks. So you have a shock in a country, and the credit channel actually, instead of contributing to move losses across jurisdictions, actually contributed to dismissal of assets in those countries and to the deepening of the crisis, which means that financial integration worked in the reverse here. There was a disintegration exactly at the moment in which you were most in need of integration. So basically, no private risk sharing in the area as a whole, which is, in my view, one of the most difficult hurdles that we have so far. Now, this chart maybe interrupts a little bit the flow of the talk, but I think it is important to say that because so far I could have given you the impression that financial integration is always a good thing, and the more you have of it, the better. No, actually, let's say it is clear that the levels of financial integration reached before the crisis were probably, let's say, to some extent, not sustainable. I mean, there are good arguments that the level of price integration that you see up there just before the crisis were actually driven by excessive risk complacency and by, let's say, investors, let's say, putting money in different borrowers without taking into due consideration the risks that they were taking. So this is a chart from study of Cecchetti that shows that after you reach a certain optimal level of integration, actually excessive financial drive in cross-border financial flows could attract excessive resources to the financial sector and lead to a bloated financial sector and subtract resources to more innovative sectors of the economy. So there could be too much of a good thing. So there could be an excessive level of integration. But the point I want to make in general is that the pendulum following the crisis has definitely swung back too much. And we are now back into a setting of excessively fragmented markets in the European Union. And in the euro area and the banking union in particular. Now, what have been the drivers of this? Indeed, there has been a strong policy push towards segmentation. The policy push is usually labeled as ring fencing. So you have basically establishments of foreign banks in your jurisdictions. So let's say, let's make an example. You have, it happened very much in Central and Eastern European countries at the beginning of the crisis. Charles probably remembers that the IMF, the EBA, the ECB tried to, let's say, provide some institutional support to deal with this issue. I mean, if you are a host authority and you receive a lot of, your financial sector is dominated or significantly, let's say, populated by subsidiaries or branches of banks established in other countries, you're very concerned when you are facing the start of a crisis that eventually you could be left with the hot potato in your hands, so that the foreign banks could leave the keys to the local authorities, and basically you find yourself having to reimburse depositors, maybe to support the local banks, to use taxpayers' money to support the local banks, or could have significant and very detrimental loss in lending capacity to the real economy in your country. So that's what led many authorities to ring-fence capital liquidity in their domestic jurisdictions. So they try to jack up the capital requirements for the subsidiaries in their country, to trap liquidity in that market, and this led to a significant tension also between authorities. I remember I've been sitting actually in countless telephone calls in which I tried to mediate between home and host authorities in cases in which the host authorities were trying to, let's say, basically ring fence, trap all the capital and liquidity they could possibly trap in their domestic jurisdiction. One case was, for instance, a few weeks before the Greek referendum in 2014 it was, I think. Anyway, in the summer a few years ago, a few weeks before, of course, the subsidiaries of Greek banks outside of Greece were asked from their headquarters to repatriate liquidity because the headquarters were hungry of liquidity. And the host authorities were extremely concerned about this development, because they were concerned that if the banks eventually, if developments turned wrong and the banks were eventually entering into a crisis, they would have been left with banks without liquid assets, and they would have had to reimburse local depositors in their jurisdictions. I mean, those cases trying to craft, as we did with the Central Eastern European countries, with Greece, with Cyprus, and with other jurisdictions, solutions to help authorities to find cooperative ways forward in terms of avoiding strong barriers at the frontiers, but at the same time taking into account the concerns of both home and host authorities was particularly challenging. Another point which is quite clear is that in many cases you had governments that had to deploy significant amounts of taxpayers' money to support the banks. And of course, this support came in many cases with an implicit or explicit request to those banks to restructure their business and refocus on support to the domestic economy. So if you are the government of a country, you tend to, support the bank, but you ask them to guarantee yourself that you would maintain lending to domestic SMEs, to domestic households, and disinvest mainly in foreign jurisdictions. This was the main driver of the repatriation of assets and the closure of foreign branches and subsidiaries in many cases. There is research which has been done here in the UK on UK data that shows that foreign banks having establishments in the UK, which were either nationalized or bailed out or supported by their home governments, reduced their decreased by 15% the ratio of UK exposures towards domestic exposures. So there was a significant reduction in the cross-border exposures. And it is also true, it is also visible in this research that after the support, there was a shrink in the numbers of jurisdictions that these banks were serving. So they were actually pushed also to reduce the number of countries in which they were present. So there is a clear evidence that, let's say, the public support went with a, let's say, renationalization of business. An important element which has been recently introduced in the toolbox of regulators and supervisors are the so-called macroprudential requirements. So the idea that regulators should be able to maneuver the requirements to banks in terms of liquidity, in terms of capital, in relation to the cyclical risks, for instance, or the systemic risks that are materializing in that jurisdiction. And there is, again, in my experience, some evidence now that also these instruments have been used to some extent to increase the requirements domestically for banks which were operating on a cross-border basis. Now, moving forward to the debate of these days, the signals are all there that this extreme swing in terms of the trust between supervisors and the repatriation and renationalization of assets pushed by policy choices is still in play. I mean, there is no evidence that there is now, that after a first reaction to the crisis, now banks are let freer to develop their international business. I can make two examples here, which in my view in terms of policy choices are particularly relevant. One is a bit technical, but bear with me, is the so-called debate on waivers. So the idea is that if you are a bank resident in Italy, let's say Unicredit, and you have a subsidiary in Italy, the regulator can waive the requirements for that subsidiary because in any case it controls the group, no? So there is no need to have any constraint to the ability of Unicredit to move capital and liquidity freely between the parent and the subsidiary. These waivers do not exist on a cross-border basis. So you cannot do this. Unicredit cannot benefit of the same waiver for its subsidiaries and branches in, say, Austria or Slovenia, so a few kilometers across the border. The Commission, now that we have the banking union, so we have a single supervisor in the euro area for all the countries in the banking union, proposed to extend these waivers to the full banking union, and this is being pushed back significantly at the Council level. So member states still want that the control and the release of liquidity and capital is allowed only within national borders, even within the euro area, irrespective of the fact that you have a single supervisor for the area as a whole. A second point, which is very delicate in the current debate, is the discussion on deposit guarantee schemes. The Commission has made a proposal already now a couple of years ago, to establish a common deposit guarantee scheme at the European level, at least at the euro area level. And this is being again resisted very much. And now let me try to convey to you what is the relevance of this proposal for the integration of the market in the euro area. We have experienced during the crisis clear swings in funds which were driven by the perception that the credit standing of a bank was actually driven by the credit standing of the sovereign that were offering that bank with a safety net. This means that when there was the crisis in Greece or in Cyprus, depositors were actually shifting their deposits from Greece and Cyprus to other European member states. This meant that de facto the euro lost its singleness, in a sense, because 1 euro in Greece was not considered anymore of the same value as 1 euro in Germany or the Netherlands. And when there were concerns about the ability of the local deposit guarantee scheme in Greece to support the banks there, of course, this outflow in deposits accelerated significantly. So now the proposal of establishing a single deposit guarantee scheme is key in restoring the unity of the single currency, but it is indeed much resisted at the political level. Let me say also that from the point of view of the fiscal impact of this proposal, it's not, in my view, such a big deal. I mean, if you look at the big figures, it's actually 5 trillion of euros of deposits in the euro area, so it's a big figure. I say, okay, are we really ready to move to a common backstop for this huge amount of deposits? I understand that politically this could be quite tricky. But as a matter of fact, most of the large banks that would go into resolution rather than liquidation would not need any support from deposit guarantee schemes. They would not be liquidated, so there would be no need to reimburse insured depositors. So the actual amount that would be needed is quite manageable with the private resources that finance deposit guarantee schemes. And by the way, if there is need for more funds from deposit guarantee schemes, even if there is a fiscal backstop, this fiscal backstop could actually get back the money from the banking sector in the following year. So we are not really talking about mutual liabilities and fiscal risk sharing, but still this is remaining very controversial. Now let me move to Brexit. How does Brexit fit into this picture? Of course, Brexit has a lot of dimensions that are not my cup of tea, so I would not dare venture into those areas. But from the point of view of the banking sector, so besides being a major political development, it is indeed factually an episode of fragmentation in the heart of European financial markets. Traditionally, London has been the major European Union's hub in the area of wholesale banking, and in particular the primary center for clearing some most over-the-counter derivatives. Interest rate swaps in particular are almost all, I think 92% of interest rate swaps are actually, euro-denominated interest rate swaps are actually here in the UK. And if you look at the turnover of the US banks, you also see that actually the US banks operate in the single market almost exclusively through the London gateway. So again, more than 90% of the turnover of the top 5 US investment banks present in the European Union was located in the EU until 2014. The bar chart here shows you in green the amount of euro-denominated derivatives which are cleared in the UK. The red one is the US, and the blue one is the rest of the world, which gives you an idea of how little of euro-denominated derivatives are actually cleared within the EU27, let's say. So the bulk of it is in London, and most of the rest is in New York. Now, if you look at the red lines which have been made public by the UK government so far, it is difficult to think that this type of business will continue to be possible with the current regime of single passport, of free provision of services across jurisdictions. The UK government has made clear that they don't intend to continue participating in the single market, for instance, by adhering to the European Economic Area like Norway, Liechtenstein, or Iceland. And this means that basically there will need to be some elements of change in the way in which these services are provided across the European Union. Change is already taking place. I mean, this chart shows you the decline in the exposures of EU banks in the rest of the European Union, in the EU27, towards the UK. So there is a significant decline, and you see clearly that the second quarter of 2016 is the moment when it starts going steeply downwards, both in terms of assets and liabilities. And the bar chart here, which again you surely cannot read, but basically shows that the largest driver of this development are derivatives contracts. So capital markets. So the city has been the main wholesale banking market in euro-denominated contract, and the key market in terms of derivatives and derivatives clearing for the EU as a whole. And this is starting to change. To be honest with you, this could also reflect to some extent exchange rate development. So it's difficult to disentangle the two, but there is a clear trend which is towards, again, fragmentation. Now, what are the main challenges that we see from our viewpoint in this development? Of course, now we will take a purely European perspective, so U27, my cup of tea in a sense. The key point is that is the loss of access to funding markets in the UK for other European banks, and the potential loss of access to financial market infrastructure, so central clearing for European banks and other counterparties, if we don't manage to find ways to continue transactions with the same ease that was the case so far. Another important area in which there are serious concerns is the area of continuity of contracts. So the key point is, can a contract which has been written and signed under the current, let's say, regime, can it still be honored after Brexit? And this is particularly relevant for insurance contracts, which are not, again, in my field, but basically if you have if an insurance company has to pay a customer in case of the insured event materializing, actually this is a service that cannot be provided if you don't have a passport to provide it. So that could disrupt very much insurance markets. And the second is, in derivatives markets, few doubt of the fact that a derivative contract would still be valid also after Brexit. The key point is that derivatives contracts are so complex, and in many cases they are bundle of different services. So you have, for instance, an interest rate swap, which is provided together with a liquidity line, for instance, or a commodity, let's say, future, which is provided together with another, let's say, with a loan facility which can be tapped for loans to emerging markets, for instance. So how to disentangle this is extremely complicated, and it is not. It is actually very likely that some of these services will not be possible to provide them the day after Brexit. So this leads to the very complex issue of repapering of contracts. So many banks will have to, go to the customers one by one and try to change the features of the contract and shift the contract from the UK, company to the company located in the EU. And that's very tricky. I mean, the amount of contracts that you have here is mind-boggling. I mean, I was discussing with a major investment firms a couple of weeks ago, and they told me that they have more than 30,000 contracts that they would need to go through in order to revise them if they were forced to repaper them all. That's why the industry is asking for a sort of general grandfathering clause that would make all the contracts which have been signed before a certain date valid in the future, something like the Euro clause that was introduced when at the inception of the monetary union in 1999. The problem, as I said, is that these contracts are so complex that you cannot know what you would grandfather, actually, which type of services would be grandfathered, which makes this very complicated. Another point which seems to be less relevant, but indeed it is very important, is data transfers. I mean, if you have transactions, you might need to transfer data of your customers from one center to the other, and with the privacy regulations, actually the GDPR just entered into force last Friday. You probably have been harassed many times by people asking your consent to use your personal data in the last weeks. I mean, this means that you will not be able anymore to move data across the channel after the day of Brexit. And this could indeed generate a lot of troubles in terms of financial transactions, which are de facto, let's say, very information intensive in terms of their content. Just to give you an anecdote, one of the big headaches we have, because also the EBA will be moving to Paris as a result of Brexit, is that we will have to move our data centers. So as the industry will have to try to relocate our data, while it would have been much more convenient for us to keep the data centers in the UK until the end of the contract, which was, I think, end of 2020. But we are concerned that if post-Brexit we cannot shift the data anymore to the European Union after Brexit, we have to, let's say, anticipate the change and pay unreasonable amounts of money to do this before the end of the contract. So a lot of practical problems, which lead us to the main issue that banks need to prepare. And we keep saying that there is a positive development, which is that the UK government and the European Union have recently achieved an agreement on a transition period of 2 years, which would end at the end of 2020, which would give a lot of breathing space to this process of repapering contracts, of shifting data centers and the like. The problem is that we don't know whether this transitional period will actually be there or not. Because if eventually, for any reason, there is no final agreement, or one parliamentary passage, either here at the UK Parliament or at the European Parliament, eventually doesn't lead to a confirmation of the agreement, to an endorsement of the agreement, it might well be that on 30 March we find ourselves without any agreement. And if this is true, and if the banks have not prepared their contingency planning, we could be indeed in a place in which banks might not be able anymore to serve their customers. Now, banks are preparing. They are at different stages of preparation. Some are very advanced. Some are actually banking on an agreement, and we are trying to put more pressure on those banks. Here we're talking about banks, but banks are not the only animals that are, let's say, in this jungle of Brexit. One area, for instance, in which I am very concerned is payment services. we just had a major opening to competition of payment services markets at the beginning of this year, and we have plenty of payments institutions, in many cases very innovative fintech providers, that are offering payments cards to customers via passport throughout the European Union. Now, of 6,000 payments institutions we have in the European Union, 3,000 are located in the UK and are giving services via passporting. Unfortunately, or fortunately for them, I don't know, these firms are not very, how can I say, I mean, they don't devote a lot of attention to regulatory developments. They tend to consider them not that important. They focus more on technological developments, which is good. But the problem is that they have not been fast enough, in my view, to ask the licenses that they would need to continue providing services in the other jurisdictions. So for the UK firms in the EU, for the EU firms in the UK. And many of them have come to me in the last weeks telling me that now they are concerned because they are moving now to go to the authorities, and they find that there is a big queue of firms who applied before them. There is going to be a huge bottleneck in terms of providing licenses, because the ability of regulators to process these licenses is limited. And this is a rather a bureaucratic nightmare that we would like not to have. Now let me go quickly towards the end of the presentation. I mean, if you are with me with the main point that actually there is benefit in financial integration, how can we restore financial integration within the EU, especially within the euro area, and how can we prevent extreme disintegration from events like Brexit? Now, the general principle to me is that financial integration is facilitated if you have trust and cooperation between authorities. Financial regulatory and supervisory authorities have a mandate to ensure financial stability and prudential soundness in their own respective financial systems. The more global the financial flows become, the less control you have on what is happening to your firms. To have control on how fragile your firm is, you need to understand what is going on in the neighboring jurisdiction where they have business. Which means that you need to have some channels for, cooperating, exchanging information, and coordinating actions with other supervisors and authorities. And this is true in general, but it is particularly true in crisis and resolution scenarios. Because, of course, if by experience you know that in a crisis you would not be able to cooperate, by backward induction, you do not cooperate even in good times, because you know that in bad times you would have the crisis hitting the establishments into your jurisdiction. So you have basically two ways to deal with this issue. One is to anticipate the ring fencing and to institutionalize it, basically, and to insert it into the legal framework of your jurisdiction. This has happened. For instance, in the US, one of the first reactions to the crisis was to introduce this so-called the ruling on foreign bank organization, the FBO ruling of the Fed, which requested all the foreign organizations to have an intermediate holding company located in the US, which means that this company needs to be completely segmented from the rest of the group and compliant with all the requirements under US regulations, which means that basically you can avoid caring about what happened in the other jurisdiction because you treat this intermediate holding company as the main object of your activities, which means also, of course, that you ring-fence capital, liquidity, and everything in your own jurisdiction. Now, the European Union has started introducing the very same provisions in the European directives, the so-called IPU, the Intermediate Parent Undertaking. So also in this case, everybody who needs to operate in the European Union would be forced to establish a parent undertaking, either a subsidiary or a holding company that will need to be fully supervised by European authorities. And this would have also an impact on the pressure for UK firms that will intend to continue operating in the single market. Other similar provisions are that you ask, for instance, now this is getting a bit too technical maybe, but the idea of pushing banks to have additional loss-absorbing capacity locally. So you want not only to have capital and liquidity locally, but you also want that there is, for instance, that the parent company subscribes junior debt issued by the subsidiary in your jurisdiction, so that if there are losses, you can escalate those losses to the parent undertaking in the foreign jurisdiction. So even additional requirement that would imply that to do cross-border business, you need to have a significant amount of commitment in all the jurisdictions and a significant amount of impediments to integrated management of liquidity and integrated management of risks across countries. The other course of action is instead that you put in place stronger levels of cooperation and transparency between authorities in different jurisdictions, and that you try to identify elements that can restore the trust between the authorities. This is not easy, but it has been done. I was mentioning the Vienna Initiative before. In those cases, there were the EBRD, the IMF, the ECB, the EBA that sat with the authorities, European, let's say, core countries, Central European authorities and Eastern European authorities, and contributed to develop memoranda of understanding according to which the parent undertakings were committing to support the subsidiaries in Central Eastern Europe in a crisis. And in front of this commitment, the local authorities allowed to, let's say, to have liquidity and capital flowing more freely towards the parent companies. A proposal that is now floated, which in my view would be an interesting way forward, is the legislation that the Commission just proposed on European market infrastructures, the so-called EMIR, the European Market Infrastructure Regulation. Now, as I was mentioning before, most of the derivatives at the European level are now cleared in the UK. So what the Commission is proposing is that they can continue being cleared in the UK also after Brexit, provided that the European authorities have sufficient access to information from UK authorities and sufficient cooperation arrangements with European authorities that they can be confident that the risk management of these exposures is sufficiently robust. So if you have cooperation, you can actually allow quite a significant amount of business to remain in the UK. If instead you are not satisfied with the amount of information you get in this process, you have a clause that allows you to push the banks to repatriate the business in the EU27. And I think this is a wise way to do it, because the bulk of cross-border business, capital market activities, wholesale banking activities are generally requiring a high degree of centralization in risk management. And only if you have the institutional arrangements that allow this to happen, you are actually supporting cross-border business. If now the European authorities were asking to fragment all this business across different, let's say, jurisdictions within the EU and to repatriate all the business from the UK, the impact would be massive. In all likelihood, you wouldn't have simply the same amount of business moving from one jurisdiction to the other, but you would have, in all likelihood, a much reduced amount of business, and possibly more also being relocated to other jurisdictions. Now, let me conclude on this point on M&As. We are now focusing on that very much because an area of concern to me, I mean, when, in an event last year, I was asked what would be, in your view, an indicator of success of the banking union 5 years from now. And my response was that if I don't see some cross-border business, some cross-border mergers taking place as some truly pan-European banks emerging in the next 5 years, in all likelihood, the banking union would not have succeeded as in the original design. So that in our view remains an important point. I was mentioning before, there is, if you are interested, there are 2 papers by Daniel Gross that I always advise to look at. One is comparing the management of the crisis in Puerto Rico and Greece, and the other one is comparing the management of the crisis in Nevada and Ireland. And it is interesting because Nevada and Ireland, on the one hand, and Puerto Rico and Greece, on the other hand, are very similar in terms of size, in terms of origin of the problem, a sovereign crisis in Puerto Rico and Greece, a banking crisis degenerating into a sovereign problem in Ireland and Nevada. And in both cases, as I was mentioning before, the ability of the US authorities to allow banks from other states to come in and buy assets and liabilities of local banks was instrumental to manage the process without depositors and borrowers even noticing that the banks were exiting the market, while, well, I suppose that Greek and Irish depositors and borrowers noticed indeed that there was a problem in their banks. So this is an important element. The possibility of having mergers, acquisition of assets on a cross-border basis is crucial. And so we will go through a sort of analysis of the impediments to cross-border mergers and try to see whether we can propose solutions to restore some degree of cross-border business going forward. So I will leave it here, and I very much looking forward to your questions and comments. Thank you very much.